You may not be worried about inflation right now, but price shock could creep up on you, says Mike Hanus from the Inflation Hedges Strategy. Welcome, Mike.
Thanks for having me here today.
Was a negative 0.2%. Should I be worried about inflation? Why should I buy?
Well, two thoughts on that. First, really understates the amount of inflation. People in our mutual fund, for example, go to grocery stores, they pay college tuition, they pay health insurance premiums, things of that nature, and they're all skyrocketing. So they come to us and say, well, I look at the CPI and it says that inflation seems to be shrinking, but in day-to-day life, it really seems to be going up quite rapidly. So what we do is we look at other measures of inflation. There's another measure called the shadow government statistics, and basically what they do is they look at CPI, but instead of all of the modifications that have gone on with CPI, they just use the original measure consistently, and that indicates CPI is running in high single digits, around 9%, instead of the number that you just cited.
All right, so we should watch the shadow and not the government number. Tell me more about your particular fund. How do you manage it?
Well, we have allocations to various asset classes that are sensitive to inflation. Things like commodities, natural resource equities, bank loans, and tips. And we get high quality sub-advisors, firms like Wellington Management Company, Mellon Capital, the Boston Company, to manage those individual allocations and make decisions in each of those various asset classes, because we're not the experts in, say, gold, for example, or things of that nature, but they are.
So you find the best managers. Let's talk a little bit about commodities right now. We've seen commodity prices come down. It's pretty good with the summer driving season upon us. And they say China is slowing. Well, you never know from China. That's why I say they say. But it's down to 7.7%, which is down from double digits. So how worried should we be about commodity inflation when we see prices coming down?
Well, I think you should be very worried about commodities. We believe you need an allocation to commodities, but we all saw what happened in 2008. Commodities came down very hard, 50%. So with our sub-advisors, we use long-short managers, so the ability to protect a portfolio if things are going south. They'll short and make money on the short side.
Well, speaking of going short, it would have been great to be short gold over the last few weeks. Gold went down. So now, do you use gold in one of your baskets? Because a lot of people thought this was a very safe investment, but they were proven wrong.
Well, our sub-advisors have the ability to use gold. Right now, thinking about the portfolio, I think that our sub-advisors are really emphasizing more on the equity side, looking at the gold miners as opposed to gold itself.
You also said you own bank loans and tips. Now these reset. It's a good way to play inflation because they reset either quarterly or however that particular note is structured. So why do you like these? Even though I just kind of gave the answer, right?
Well. I'll tell you, we like bank loans, also known as leverage loans, a lot, and we're overweight those because they do reset, and so that picks up the inflation. We don't like tips, and we're severely underweight tips right now because we think there's not good value there. So right now, and that's one of the things that we think that we provide value on. We're able to look out at the market and identify where things may not be so attractive like tips, but find something else that could be attractive and try to overemphasize that asset class.
All right, thanks a lot, Mike, and good luck with the fund. And thank you for watching The Street.